Georgia citizens pay the fourth highest electric bills in the United States. Why? In December 2019, the Georgia Public Service Commission met to set new rates for Georgia Power. Because Georgia Power is a monopoly provider of electricity in the state, it's the Commission's responsibility to regulate how much money they can make. Commissioner Vice Chairman Tim Echols passed a motion to set an unusually rich capital structure for Georgia Power. What does this mean for you? What is capital structure? The capital structure is the balance between debt and equity that a company uses to finance its assets, day-to-day operations, and future growth. Debt comes in the form of bonds, and equity comes in the form of stocks or retained earnings. Georgia Power's capital structure is set by the Public Service Commission to ensure that it is fair to the company and that it's the least expensive as possible for consumers. That's supposed to be the goal anyway. Public Service Commission public interest staff brought in experts in utility financing to analyze what is a reasonable capital structure for Georgia Power. Here you will see one expert, Michael P. Gorman, testify before the Commission that a capital structure of 49% debt to 51% equity is fair, will sustain their current credit rating, and keep rates affordable for Georgia Power customers.
The company proposed to set rates with the 56% common equity ratio. I propose to adjust that capital structure to maintain the 51% common equity ratio. A 51% common equity ratio represents a more reasonable cost of capital.
However, Georgia Power wanted a more financially rewarding capital structure, so they asked for a richer 56% equity instead of the 51% that Mr. Gorman recommended. A 5% increase in equity in the capital structure might not sound like a lot, but it adds up to $267 million in extra earnings for Georgia Power per year, above an already healthy profit. Coupled with an also unusually high ROE, which is another rate set by the Public Service Commission, the actual extra earnings per year are $482 million. This extra $500 million is paid by you, through high electric rates and high bills. So why did the Commission adopt this extremely rich capital structure? Georgia Power's bond rating set by Wall Street agencies has declined due to their huge cost overruns for the nuclear expansion. Commissioner Echols wanted to make up for that by changing the capital structure. The PIA staff asked for a capital structure to remain at 49% debt to 51% equity because it is the most affordable mix for consumers. Debt only costs 3.86% and equity is more expensive at 10.5%.
During Energy Committee meeting last Thursday, PIA staff and several other parties voiced opposition to various parts of the proposed agreement as filed. The matter is ready for your decision.
Number two, that we set the company's capital structure as filed.
Commissioner Echols likes to repeat the claim that the credit rating will drop if Georgia Power doesn't get higher and richer rewards than any other utility in the U.S. But this is false. Georgia Power's bond rating has already dropped because of their inability to meet their own timeline and because of the cost estimates for 2 new nuclear units at Plant Vogtle. Commissioner Echols always votes in favor of Georgia Power profits over Georgia citizens. So if you notice your electric bill getting higher, it's not you. It's them. Commissioner Echols ignored his own staff and voted for a much higher capital structure than other utilities in the United States. Now it's your turn. Vote Commissioner Tim Echols out of office.